Good morning, everyone. Hi, it's so nice to see all your smiling faces and this enthusiastic chatter. I think we're off to a great start. So my name is Nikita Boston Fisher, and I have the privilege of serving as the Associate Director of the Laidley Center for Business Ethics and Equity. And it is my pleasure to welcome you to our annual Business Ethics Conference today. Before we begin, I invite us to reflect on the land on which we gather. McGill University stands on territory that has long served as the site of meeting and exchange of indigenous peoples, including the Haudenosaunee and Anishinaabe nations. We acknowledge and thank the diverse indigenous communities whose presence continues to shape this land. This year marks the third edition of our annual Business Ethics Conference, a milestone that speaks to the growing importance of ethical dialogue in business. Our theme this year, Ethics in Finance, could not be more timely. Finance is not merely a mechanism for capital allocation, it is a powerful force that influences societies, economies, and futures. With that influence comes responsibility. The responsibility to act with integrity, fairness, and foresight. Ethical finance is about more than compliance. It is about cultivating a system where financial institutions and professionals serve not only their clients, but the broader community, promoting sustainability, equity, and social well-being. It is about integrity, fairness, and accountability. Today, we gather to explore what this vision looks like in practice. Since many of you may be joining us for the first time, allow me to share a brief history of who we are. The Laidley Center for Business Ethics and Equity was established in 2022 in the Desautels Faculty of Management, thanks to the generosity of our BCom 67 alumnus, David Laidley. His commitment made possible our mission to serve as McGill's hub for ethical decision-making in business through teaching, research, and community engagement. In just 3 years, we have built a vibrant ecosystem of initiatives. This annual conference each November, an international case competition each March, drawing 16 teams from across the US and Canada, a student fund empowering students to organize and participate in their own ethics and equity-related events. We've brought the Ethics Bowl Canada competition for high school students to Quebec, hosting both the French and English versions here on campus. We collaborate with our EDI team on events for Black History Month and Women's History Month. We host something called Ethics Research I'm Excited About, which brings together researchers from across our campus to share their research in 3 slides and 5 minutes. We have an Ethics Ambassador program for students who are keen to get involved with the center. And this past September, we are excited to have launched an ethics concentration in the BCom program. We've also gained platinum rating in the McGill Sustainable Workplace Certification, and we are exploring partnerships with an ethics center in Nigeria. We continue to build and grow our activities based on feedback, and we want to be certain that our work is relevant to the audiences we serve. So after today's event, you will receive an evaluation form. Please take 60 seconds to fill it out. Our work also extends beyond campus, as we are participants in McGill's Pick Your Path program, which exposes underrepresented high school and CEGEP students to what university life on our campus could be like for them. Our center director, Lindsay Holmgren, also serves as the ethics advisor on McGill's Generative AI Advisory Committee and the University IT's Advisory Committee on Generative AI. She also gives ethical leadership talks to various organizations that are part of the Quebec English School Board. As we dive into today's panels, let's set the stage with a few community agreements to guide our conversations. We'll engage in respectful dialogue. We welcome diverse perspectives, so please listen actively and engage with curiosity and not judgment. We ask everyone to speak from experience, sharing their own insights, but avoiding generalizations. And we're going to assume positive intent, as we're all here to learn and grow together. These agreements help ensure that our dialogue today reflects the values we champion: integrity, equity, and respect. Today's program reflects a spirit of shared responsibility. We will engage with 3 panels, each examining finance through a critical lens: finance and sustainability, finance and equity, and finance and social responsibility. These conversations will challenge us to ask not only what finance can do and is doing to move beyond profit towards purpose. Before we begin, I would like to thank our speakers and moderators for agreeing to share their insights, and to all of you for being here. Your presence affirms a collective commitment to shaping a financial system that serves society with integrity. And now, it is my pleasure to hand the proceedings over to our first moderator of the day, Accounting Professor Hong Ping Tan, in our Desautels Faculty of Management, who will lead our first panel discussion, Finance and Sustainability, Capital in the Anthropocene. Thank you, and I hope you enjoy the conference. Please stay with us to the end and network. Thank you. Hong Ping?
Thank you. And welcome everybody to this conference. I'm going to moderate for the first panel on ethical finance. So I'm going to introduce my speaker first. Toby is the CFO of Corporate Knights. Have a seat. Can you guys turn on the slides? We do have some slides. Yeah, thank you. And so Toby has been in this sustainability and finance for decades, if I'm not exaggerating. And he's the founder of the Corporate Knights, and they have done many fantastic job in linking sustainability to finance, to investment, and to the big community. So welcome. And then next I have Sebastian. He is the VP, Vice President of the Canadian Development Investment Corporation. He has, again, decades of working experience. He's very young, but a lot of work, especially in the government-related projects, linking those big development projects and dealing with the indigenous group. So he's going to share a lot of insights in this sustainability and the finance and investment. And finally, we have this beautiful lady, Ipek, my colleague, assistant professor in Desautels of Faculty of Management. So today, our topic, our panel is on the ethical responsibility and consequences of sustainable investment. And if you go to the next slide, please. So nowadays, we know the climate risk play a big role. What do we mean by climate risk? So basically, we're talking about those physical risk and those due to those acute events like tsunami, global sea level, global warming, etc. And we also talk about transitional risk, all those changes, involving in the transition to the no economy, right? So I did a quick literature survey in the academic research related to the climate risk. Can you skip to the next slide? So I downloaded over 40,000 papers in the area of accounting and finance since 1995, 1994. And out of these 40,000 papers, we screening for the discussion of climate risk and environmental risk in the area of accounting and finance. And we end up about 2,000 papers talking about climate risk. And you can see a big increase of the academic interest of this important topic, right? Especially, there's a surge since 2017, especially after 2020. You see a spike of academic interest in accounting and finance. So I go further and try to understand what is the landscape of the academic research related to climate risk, related to green finance. So can you click to the next one? So these are the major topics. We use a dictionary approach and use the machine learning per topic and machine learning models to try to dig out from the abstract, from title, what are the topics related to accounting and finance, with regard to the climate risk research, right? So you can see a lot of topics show up in the climate risk related research. And the traditional accounting and the finance topic, like all those major intermediaries like analysts, auditors, institutional investors, and banking. So here we have very mixture of the opinions from diverse group. We have the practitioners, we have the academics, and they are going to share their insights on this sustainability, sustainable green finance. Okay, so I'm going to start with Toby. So he's going to share his insights about this important topic. Welcome.
Is it good to sit here or?
Yes.
Okay, well, thank you kindly, Hong Ping, for the invitation, and thanks everyone here for joining today. This is the first time I've been back in the faculty club since, I was thinking on the way here this morning, since 1997. I was a student here, and I had taken an option course in Italian architecture, which had several prerequisites I had not taken, so I didn't really know what was going on in the course. And the professor felt sorry for me, and so met me at the Redpath Library the day before the final, and took me with one of those carts that you can gather books with, and then proceeded to gather about 150 different books about architecture. And then he saw the look of terror on my face and kind of sat me down. He said, so you can either read through all of these by tomorrow morning before the exam and digest it, or we can go to the faculty club, shoot a game of pool, and I'll make sure you pass. So I don't think that happens too often, but the topic of finance wasn't something that I was originally taken with. I was more interested in the environment and in human rights when we started Corporate Knights. But what gets funded gets done, and quickly, if you're writing about business, about change, you get to finance. Finance is the nub of everything, and if you want to change what's going on with climate change, which is what we spent a lot of time over the last 20 years at Corporate Knights working on, tracking climate capital expenditures from the 2,000 largest firms, writing the stories about the transition, looking at what the capital would be required to transform Canada's current energy system from mainly fossil fuel, on a total basis, 75% fossil fuels of our total energy, to close to 100% renewables. It's basically a finance question. It's a $1.5 trillion capital expenditure, and the change that it brings about is pretty profound. There's a lot of spreadsheets and numbers, but if we make that transition and we electrify all of our buildings with heat pumps, which Quebec has a lot of, electrify our road transportation, with electric vehicles replacing the internal combustion engine, and build out the grid so it's smarter and it can do more vehicle-to-grid and storage. If we do all that, it costs about $1.5 trillion over 25 years. But what it does is, right now we're spending $175 billion every year on fossil fuels. So at the pumps, for the gas, the heater homes, that's $175 billion of operating expenditure in the economy of Canada spent on fossil fuels every year. And if we replace that with electrified heat and electrified mobility, it cuts the annual bill in half. And the reason it does that is because electricity is about 4 to 6 times more efficient, whether it's to heat something or to move something, than fossil fuels, depending on the use case. And it's a little bit more expensive per unit of electricity at the moment, but it's 4 to 6 times more efficient. So that $175 billion we're spending every year on fossil fuels goes down to about $90 billion if we replace it with electrified infrastructure and electricity. But it doesn't happen unless we make that big investment. And the investment is happening, but it's not happening at the speed that the economic fundamentals would justify, mostly because finance, like other aspects of society, is sticky, has a lot of inertia, and tends to have a bias for most things, for the things that are, as opposed to the things that are coming into being, more of a bias to, in this case, sunset industries rather than sunrise industries, the electrification. So I have kind of 3, I guess, main questions, but just the table setting, I think we're all interested in the ethical implications of finance because we're interested in bigger ethical questions of our civilization. And if we look at the 2 primary metrics that I pay attention to relative to the state of people on the planet, there's one called the global ecological footprint. It comes out every year. It measures how much nature we have, fish, forest, ability to regulate a stable climate, and how much nature we're using. And then it has Earth overshoot days, so that's the day after which that day we're using up more resources than planet Earth has to give us. This year that day came July 25th, so every day since July 25th, we're operating in a deficit with nature. We use about 1.7 Earth's worth of services each year, and so that's creating deficits in terms of deforestation, in terms of fisheries collapse, in terms of climate regulation, and that has many implications for people. If we look at the inequality side, we can look around and we can see that the earnings of billionaires just in the G20 countries last year of 2.2 trillion in earnings would be more than enough to pull the 3.6 billion people living in poverty out of poverty. If we look at just the 36 richest billionaires in the world, they have wealth that is greater than the 3.6 billion poorest people. And so we do have a system where wealth has got gummed up in a really narrow segment of society. And that has implications for productivity and justice and human rights. And we are mortgaging our future by using 70% more of the planet's resources than it has to offer. So when we come to finance, if we're thinking about finance, why finance matters, to the point earlier, what gets funded gets done. One of my mentors, who used to be head of strategy for Goldman Sachs and has done a lot in sustainable finance in Canada, sits on the board of RBC now, he always says that what gets funded gets done. Andy Chisholm. The second question, why finance matters. If you care about the future, what we invest in today is going to determine the future of tomorrow. Now, if we ask ourselves, what is finance for? I would argue it's not just to earn risk-adjusted returns. It's not just to grow money. Those are important aspects of it. But finance exists to build a better future. It's essentially a hopeful invention of our civilization to take our resources that we can gather today and imagine something better we could do with them, and then do that thing, whether it's building a railway to connect our country, which is why we have a country, still have a sovereign country, or it's to build out a transmission grid that enables renewable energy to power all of this today, which is what Quebec did in taking a sort of disjointed grid that was owned by private sector and it was not that well integrated, and then bought it up with René Lévesque leading the charge to create the mass of Hydro-Quebec, which was one of the most successful renewable power companies in the world, and is a big source of prosperity and also ecological leadership here in Quebec, not without some warts and issues, but all in all, a great example. When we look at what finance is actually doing right now, it is mostly helping to concentrate wealth in a small portion of society. It is building out many good things, and one of the things that I often find people are surprised by, because a lot of the headlines aren't always as hopeful as the reality is if you look at the amount of capital globally allocated to clean energy this year, this is according to the International Energy Agency, we're on track for $2.2 trillion of capital to be invested globally in clean energy this year. And just by show of hands, how many people think that's more than the capital that's being invested in fossil fuels, all gas, all oil, all coal? Yeah, it's twice as much. So this year there's $1.1 trillion globally being invested to expand capacity for fossil fuels, and there's $2.2 trillion globally being invested. China's leading the way. They account for about 60% of that, and they have a really intentional strategy and well integrated, and something that's been articulated and followed through on over the last couple of decades. And that's why 1 out of every 2 cars there is electric, and that's why they control over 80% of solar panel manufacturing, rare earths, and are really have an enviable spot in this massive growth engine. And I think this is the other point kind of to take out. Finance exists to earn risk-adjusted returns. at the moment for a narrow segment of society, mostly who owns it. There are exceptions there. But I would argue that finance is not even doing that job properly because of the bias towards the world as it was, as opposed to the fast-changing world that is becoming. And when we look at the growth rate, the compound annual growth rate of sustainable revenues for the 2,000 largest firms in the world, it has hovered around 20% per annum over the last 6 years. So that's through COVID as well. And we look at the growth rate, and this is publicly traded firms, 2,000 largest, of all other revenues, it's less than half of that. And so what we're witnessing is there's a multi-trillion-dollar space. It's about 10% of the global economy now by GDP of those 2,000 publicly traded companies. And it is doubling every 4 years, growing twice as fast as the rest of the economy. And most investors do not have a intentional strategy. There's data limitations. There's lots of reasons it's not happening. But at the end of the day, there's no good reason why it's not happening. And finance is lagging. And this is a really important point. Finance is lagging reality right now. It's not keeping up with the pace of change and technological. The real economy is moving faster than the financial economy, and that's not how it's supposed to work. The financial economy is supposed to front the capital and be a little bit ahead of the real economy. And so I think the financial economy needs to wake up to even just this narrow mandate of making money and get more innovative and hungry to really lead this transition to a clean energy future. But that's not going to solve all of our problems. I think that we're spending $2 for every $1, $2 for clean energy for every $1 of fossil fuel investment. That ratio needs to be about 4 to 1, according to the International Energy Agency, for us to be on track. And so if we're going to get there and get there to a world where people can enjoy that benefit, we will need to, and we see this happening in places like China, we see this happening in places like Quebec, La Caisse de Depot, the $500 billion pension fund here, which has a mandate to invest for economic development in Quebec, and has nurtured and financed and brought to fruition global champions like the green infrastructure firm WSP that would not exist without the capital provided by CDPQ. And there are many other examples. But if we want to nurture this world, this better future with finance, I would argue there are two integral things that have to be at the core of everything we do around finance. And one is creating more inclusive wealth structures. If the wealth is more broadly owned, whether it's through the La Caisse de Depot or through cooperatives like Desjardins or through employee-owned businesses, but beyond not completely replacing the shareholder primacy, but we need to grow other aspects of our economy so it's got a better balance and more diverse and much more inclusive wealth structures. And number two, we need to shift from shareholder primacy to stakeholder primacy, and really from short-term shareholder primacy to long-term stakeholder primacy. And stakeholders include non-living entities as well, including the planet. And the way we get there, I've thought a lot about this and tried a lot of dead-end solutions and been able to see some that work in the trenches of Ottawa and DC and G20s and different summits, investment houses. But I think the things, the table stakes of what needs to be in place is we need to nurture and have public policy that allows the entities with more diverse ownership structures, co-ops, employee-owned entities, public. We need to be growing those. Right now, co-ops are a $3 trillion industry globally. That's their annual turnover. Most people don't know that's 3% of global GDP. And if we can edge that number up into the double digits over the coming 15 years, there will be many, many positive ripples, including buy-in, because this upheaval that will be created from the energy transition will be much better taken if the proceeds are more equitably shared than if they're concentrated the way that things are now, and that will make it more politically resilient. The other thing that is really important is the private sector will continue to thrive and be an integral part of our economy. Banks, insurance companies, pension funds that are not necessarily part of, some of those are part of the public investment sphere. But for them, we need clear table stakes in terms of what's required. So there's the Bank of Canada Act, there's a CRA registration for major pension funds. There are many choke points, even in our balkanized federal structure, where the federal government has the power, sometimes with the stroke of a pen, to update the requirements. So major financial institutions must demonstrate that they are credibly aligned with the net zero law of the land in Canada, which is the basic sort of premise, and also will make us more financially resilient. So that is really key. And there are things we can do with carrots as well. And here I would like to just, I guess, pay respects to some of the leadership we're seeing at the federal government, not on all files, but today in Canada is a result of the recent budget, which offers 100% expensing of capital investments for almost all investments, except for just like buying buildings or whatever, but any kind of clean tech any kind of manufacturing, pipelines, power lines, whatever, are stackable with our clean economy income tax credits, which are really generous, in the neighborhood of 30% rebates in cash for investments for the whole realm of clean investment. There's 6 different types, and 4 of them are into law and articulated by CRA, our tax authority. But if you combine the 100% expensing in this recent budget in year 1 for capital investments with the clean economy income tax credits, you're a business, you make a $10 million investment today in electric vehicles and heat pumps, you get back $5 million next year. So 50%. That deal, that sweet deal, will sunset in 2 years, in 2027. The 100% expensing goes to 2027. It is a bold policy designed to mobilize capital. It's morally neutral. It does not reward fossil or clean. It's any kind of investment. But when you stack that with our clean economy income tax credits, which are quite generous, then you get about a 50% of the money you invest back as a business if you're investing it in clean stuff. And so that is really profound, a really profound carrot. I'm really looking forward to seeing what happens as a result of that. And it shows that it is possible to do big things in big strokes, even in this time of sort of incrementalism. We are going twice as fast on the investment side. Then the good stuff is growing twice as fast as the sort of harmful stuff. We need to grow 4 times as fast, but we're in a position of momentum. And I think now is the time to really be thinking about what is the purpose of finance and how do we align it with with the future that we want, while respecting its fundamental tenets. So thank you, Kylie.
Thank you, Toby. Thanks, Toby, for sharing the insights on the role that finance can play in this transition to no carbon economy. And in particular, I really appreciate your insights about the government role there. So I'm going to hold the question to later. So we're going to first hear the insights from our 2 other panelists. So I have Sebastian to share his insights related to his work involved in those big project development and involving some stakeholders, important stakeholders there.
Thanks. So I'm Sebastien Labelle. I'm Vice President at the Canada Development Investment Corporation. Show of hands if you've ever heard of Canada Development Investment Corporation. Oh, really? Some. I'm surprised. Well, maybe you're just trying to make me feel less awkward. Thank you. CDEV is a federal crown corporation. We report to the Minister of Finance. We manage over $85 billion of assets for the government. And we do a lot of different things. And I come to CDEV, I've been there for 2 years, about 25 years of experience in economic policy in Ottawa, Crown Corporations, Ministry of Finance, and a number of different things. And I'm going to try to keep my remarks short, but I will try to provoke you a little bit. I don't have as much environmental sustainability content as I would like, and so I've put some ethical issues and questions here that I think are interesting to me and hopefully also to you. So here we go. So this is just a quick overview of CDEV. We're 42 years old. In the budget, the government just tabled legislation for us for the first time, which is interesting and kind of shows, I think, why we have such a low profile. Our job was really to buy and hold assets on behalf of the government. And we've been doing that quite a lot. So selling assets, we divested Ridley Terminals. It's a coal terminal in British Columbia. recently, we've bought a pipeline called the Trans Mountain Pipeline. You may have heard of it. It's a $34 billion asset that Premier Eby now thinks can be optimized and used to get more oil to Tidewater. So again, a little provocative, maybe on purpose. We do have the Canada Growth Fund. That's a $15 billion fund that is, I'll talk about a little bit later, but that's really to reduce greenhouse gas emissions, and doing that in partnership with PSP Investments, one of the biggest pension plans in the country and perhaps in the world. So we do a lot of things. We're sort of set up to respond to priorities of the Ministry of Finance and to deliver on them as an investor and an advisor. And so most of our people are investment professionals. We're based on Bay Street in Toronto. So I thought it'd be useful to talk about ethics and values in the public service. This is the framework. It is complicated. That is perhaps the Ottawa way to make things maybe a little bit more complicated than they need to be. But I think it's interesting because it often, as government, I find you're really put in the middle of complex moral choices where there's antagonistic and polar opposites that push and pull you in different directions. I'm going to talk a little bit about democratic values. So democratic values, we report to a minister. We are, as I said, finance professionals that are used to having good deals. They're used to, as one of my colleagues says, we are taught from birth that we have to protect the money. We have to make the money. And now you're telling me to get rid of the money. And I'm confused, right? It's a very different construct, but often that democratic value, that ministerial direction forces you to think about investing in a very different way. That professional values, of course, like as investment professionals, they really want to have good deals. They really want to do good investments, and that's why we're there. I think the government's trying to be as commercial as it can while fulfilling public policy goals. So concessionality, that's a big concept for us. There's a couple definitions here from the OECD and the United Nations. I think that, as I understand it, this is, the public sector is doing deals that the private sector would not do. If the private sector could do the deal, then the government should get out of the way. And the idea is that you want to not crowd out private capital. You want to complement it. You want to set the stage maybe by de-risking certain initiatives and getting ready. And this is really interesting in environmental sustainability. As I said, Canada Growth Fund, they're really looking to support technologies that are proven but not scaled up, and taking a lot more risk than they otherwise would in scaling up that technology. And so that concept of concessionality is really, really important, but at the same time, you can be overly concessional. Concessionality taken to the extreme is free money. Just hand out briefcases full of cash and hope for the best. And the government certainly has done that in the past and continues to do that. But I think especially in the last 5 years, you've seen a big shift in having institutions like CDEV, like the Canada Growth Fund, like using PSP investments to really drive that investment rigor and bring that competence to the structuring of public support. And so I think that's very positive, but it is interesting. Also in the budget this year, the government talked about a strategic financing framework for major projects. So that's making sure that you really provide as little concessionality as you need to get that project done. Whether that be a critical mineral project to support EV batteries and things like that, or other things. So on concessionality, I just want to talk about 3 examples. Talked about Canada Growth Fund. So $15 billion, it's managed by PSP Investments. These are investors that are used to, and they're being paid to get a return. So we're asking them to do deals that they wouldn't otherwise do, frankly. The Canada Enterprise Funding Corporation, it's a $20 billion fund. that we manage directly, and that is supposed to be a lender of last resort. So when no one else will lend you money, you can call on this particular pot to help you survive, frankly. So highly concessional, highly specific, but also restrictive. So it has, for example, limitations on executive compensation. If you're getting public money, maybe your CEO shouldn't make $5 million a year, for example. It has lots of conditions around employment, around what you do with your equipment, what you do about staying in Canada or leaving. Canada Infrastructure Bank. So in this budget, they went up to $45 billion, and interestingly, 1/3 of that, so $15 billion, is earmarked in the fiscal framework for losses. So that means that it's not just allowed to lose money, it's kind of expected to lose money to support, a big chunk of that is environmental sustainability, revenue generating projects, and other really good examples. And it's really trying to, again, do deals that the private sector would not do. So it didn't start out very well. Canada Infrastructure Bank, if the Conservatives had won, they wouldn't be around. And why is that? Really, 4 years of the first 4 years really paralyzed with, like I said, investment professionals accustomed to seeing deals in a certain way, being asked to take concessional positions, not being able to do it. And that sentiment was really, I would say, widespread with respect to that. But that the way that you think about concessionality and the right level is in the public sector, I think it's quite interesting. So you have, for example, public policy objectives that are defined, sometimes clearly and sometimes not clearly at all. Sometimes the outcomes are fuzzy, jobs. How do you measure jobs in, for example, construction of a solar farm, right? So there's jobs in construction. The asset life could be 50 years. There's not a lot of jobs after year 2 or 3, right? They disappear. So how do you kind of measure that economic impact? How do you measure the greenhouse gas savings in some cases? How do you measure that public policy objective and then assign a level of support and concessionality that is appropriate? And so often, you're trying to really, again, kind of crowd in that public sector investment. I'm going to switch gears a little bit and talk about major projects, because I think there's a lot of environmental considerations there, a lot of ethical dilemmas that we struggle with, and I've worked on major projects for a long time, and I could tell you it's lots of fun because it's hard and important. So environmental sustainability, that's really the most important part of the review process. So what is the impact on nature? What is the impact on species at risk, on water crossings? And that process, quite frankly, has been killing projects, right? And maybe for good reasons, but that's the debate, right? Is it appropriate for the process itself to kill projects? In one case, you may have heard of it, Energy East, a pipeline from the oil sands to the east, cost $500 million just to bring it through to the regulatory process. So if you're asking a company to spend $500 million and not know what the result will be, I'll tell you, TransCanada Energy is not going to be putting forward any projects anytime soon because they're still recovering from that. But the new legislation from the Building Canada Act, I think, again, brings a lot of ethical and moral questions. That legislation allows you to suspend every single regulation in Canada that deals with environmental protection. And sometimes, I guess the government will have to think really carefully on how it uses that. But I think that's one really important kind of new development. The second thing, Indigenous rights, and they're really closely linked with environmental sustainability. The connection that Indigenous groups have to the land is extremely strong, and of course goes from time immemorial. Many indigenous groups, when you speak to them about projects, they talk to you about 7 generations thinking, right? So they're thinking about how does this play out in 200 years from now, and that's how they make decisions. They also make decisions through consensus, and they take time and they want to really understand what is being proposed. And so often very challenging for the government to determine whether it is an opposition to an asset like a pipeline. Is that because of concern over rights that are protected in the Constitution? Or is that another concern over, for example, lack of economic participation in the project? Or is it a concern around gaps in the environmental protections? So very, very challenging to do. And I'll tell you, as someone who's done this work, it's also time limited and time sensitive. If it's $500 million to get through a regulatory process, you can imagine every single month counts. The third is macroeconomic benefits to Canada. So I talked a little bit about Trans Mountain. That cost $34 billion. There's a lot of money and capital on the line. And again, the objective is to accelerate that process and understand it. But really, the government is often stuck between going too fast, ending up in court. Until recently, every single pipeline project in Canada was litigated. We've had 3 that weren't, or 4, and 3 that I had something to do with, so I'll take some credit, but not all of that. But really, it's about trying to balance that and fitting that into an ethical framework that makes sense. So one of the solutions is helping indigenous groups to participate. So this is another one of our subsidiaries, one that I spend about 3/4 of my time on. It's a $10 billion program to support acquisitions of ownership interests in major projects for indigenous groups. So, you might think, first the 2 objectives, economic reconciliation, so getting money, getting benefit from these projects, and the second is getting projects built and making sure there's social license to do that. And so one of the questions really, are we asking indigenous groups to trade off economic gains for environmental protections and protections to their rights? And some of them certainly think that, and they're not interested in this program, and that's fair. But I think that's, again, one of the considerations that we have when thinking about putting together instruments like this. And when we're thinking about the day-to-day of this program, we're seeing a huge range of applications from, for example, acquisition of warehouse property that would have great economic gains for the nation, to nations like the Niska running their own pipeline and LNG export facility. And so really huge spectrum of applications, and thinking about how do we prioritize that and how do we maximize these 2 objectives, which can often, again, conflict with each other. And so thanks for listening. A couple of leave you with a couple thoughts, but democratic values really inform why we're here and what the government is trying to do. Concessionality, super important. We're not investors that are only trying to get a return. We want good deals, but within limits. We want to really focus on the outcomes that go with that. And so this is why it's so much fun to work in the public sector, because you get to deal with these big issues. Thank you very much.
Thank you, Sebastian. Thank you. Yeah, thanks for sharing the insights as a people as a frontier working with all these big project, the development project involving diverse group of stakeholders, and so Sebastian has shared his view on this transition to low carbon economy from the perspective of a government initiative, right? Talk about this policy uncertainties and share some of the insights involving those big projects. So next, we'll go to our academia. So EPAC is going to share her work and her insights about the role of institutional investors or other stakeholders involved in this transition into the low-carbon economy.
Thank you, Hongping. Can we get the slides up? It's here and it seems connected, but...
How to do it?
Will we be able to get it?
The EPAC. Yeah.
Yes, perfect.
Okay.
Thank you so
Thank you.
much. Okay. So hello, everyone. It's a great pleasure to be here because I do research in sustainable finance and I teach sustainable finance to our undergraduate programs and masters in finance programs. So this is one of my most favorite topics to talk about. And I'm very happy to be part of this panel. So today I'd like to talk to you about the role of investor oversight in advancing sustainable finance. We all know that institutional investors do have the obligations and incentives to oversee the portfolio companies they own. And there are many forms of this stewardship or oversight activities, and two of the most that stand out is voting on corporate proposals, and the second one is to do engagements with the companies, with the board members or the managements as institutional investors. Of course, a natural question that arises is that whether these oversight activities extend to sustainability issues as well. So the question in general terms is that as institutional investors, can we actually engage with companies, vote on certain proposals so that they are improving their sustainability, environmental and social practices? That's the main question. And to answer this question, I'll draw on two of my papers. The first paper will focus on changing environmental and social practices through voting behavior. And the second one will focus on changing these practices via engagements, via private channels. So overall, the central theme in both of these papers will be that not all institutional investors do monitor their companies the same way, but we'll come to that. If I can start with the first idea, or the main idea of the first paper, it is the following. If we're talking about corporate sustainability, so ENS practices, we do have to make the distinction between material ENS initiatives and the immaterial ENS initiatives. Material ENS initiatives are the ones that are tied to companies' value drivers and its risk profile, whereas the immaterial ones are the rest. Think about a large bank. This bank can be making investments in climate education initiatives and programs. This might look like a good progress on the sustainability scorecard, but at the end of the day, this bank's environmental footprint is being determined by its lending portfolio and its carbon exposure through that lending portfolio mainly. So if you're just investing in these education programs without making any changes to your lending portfolio as a large bank, at the end of the day, your operations are not likely to change. The long-term value of the company will not likely to be achieved, and meaningful sustainability outcomes will not exist, right? Simply put. By contrast, if as a company you're investing in material ENS initiatives, for example, for a utility company, if you're investing in climate risk management practices, as an apparel company, if you're investing in supply chain labor standards, then what's going to happen is that your company's long-term value will improve. So this is what I mean by making this distinction. So keeping this in mind, what I document by looking at the data is the following. Companies often overinvest in immaterial ENS. And this is very often associated with managerial discretion for reputation building. In other words, greenwashing. So there is one institutional tool that disciplines this behavior, and that is the institutional investors' oversight. So by using ownership data and voting data, what I show is that active funds and index funds do selectively support material ENS initiatives. So they seem to be sophisticated institutional investors who who understand what matters for a company to achieve long-term value and support that. On the other hand, retail investors and pension funds seem to be supporting proposals that are both material and immaterial, and that negatively impacts the firm value in the long term. But of course, this voting behavior is just one part of the story. If you talk to practitioners in this field, the stewardship teams of these institutional investors, you're going to hear that the voting, so the formal publicly observable channel of influencing your portfolio company, is only a subset of your activities. The real activity and the real influence actually happens behind the closed doors via engagements. So engagement in the context of corporate governance can be defined as any interaction that you have as a shareholder with your portfolio company's representative, whether that representative is part of the management team or the board member. So what we observe is that the most of this influence happens through behind the scenes, but we do not have data on that. To overcome this issue, what my co-authors and I did was to approach company executives and survey them about their engagement experiences with the institutional investors. Particularly regarding environmental and social topics, we have asked them what type of investors, institutional investors, engage with them, what happened as a result of these engagements. And we have found some interesting things. I mean, I find it interesting, and I'm hoping you're going to find it interesting as well. So if you're an index investor, meaning you're the investor who is holding a company because that company existing in a index, so you cannot leave that company as long as this company is being listed in that index. What happens is that your priority of ES engagement with that company is climate risk. Same way for active investors. So it seems that institutional investors are aware that climate-related risks are at utmost priority for them and for the firm value as well. And that is followed by diversity. In both of these topics, what we are observing is that by asking these company executives, both types of investors are able to achieve disclosure outcomes. So as a result of this engagement, the companies say that while we increase our disclosures, particularly in disclosing climate-related risks for our business, and also our carbon emission disclosures. So very often in empirical research or project, it is difficult to tie or find the causality. We don't really know if X causes Y, but by directly asking these managers, we can actually establish that risk, so now, link, sorry. So now we know that because of that engagement, we can get more transparency and we can get more standardized metric disclosures. When we look at the changes in the operations or company policies, on the other hand, especially in environmental issues, we do see that it is the active investors who drive those changes. This is what we would expect ex ante, because climate-related policies or business changes very often requires firm-specific interventions. So you really need to have the resources and the business expertise of an active investor to study your portfolio firm, identify their operational weaknesses, strategy weaknesses when it comes to climate, and engage them on that and make those changes. Whereas for index, these institutions are holding thousands of portfolio firms. They do have more limited resources that they can allocate to stewardship activities because they are competing extensively, intensively on management fees. If you think about it, an average index fund is going to charge you 5 basis points for management fee. So they have limited resources to allocate. So with all of that in mind, we see almost none changes when it comes to companies' operations. But this doesn't mean the index investors are not useful in advancing sustainable finance, because at the end of the day, they are forming this coalition, they are forming this division of labor with active investors to help us get reliable data from companies, helping us get information that we can use when we are making our investment decisions, helping us get information that can be used by government to really regulate those companies, and for other investors to engage on these issues as well. So it is, I will say, it's an environment in which active and index investors are working together to advance sustainable finance. However, these engagement dynamics, as you can imagine, are depending on the regulatory environment that we have. Just to give you an example, in US, as of February 2025, the Securities Exchange Commission now changed the definition of control by an investor and said that if an investor is engaging with a company on environmental and social issues, if they are conditioning their director's support based on the activities of the company in these areas, then we consider those investors now not as passive investors, but as active investors. What will this cause? Now these institutional investors that used to drive these disclosures know that when they are engaging again, they're going to be labeled as active investors. They're going to engage in, or they're going to have to do more cumbersome filings. They're going to be labeled as active investors, and they're going to incur lots of operational costs and reputational costs. So what was the behavioral response? I think everyone can guess. Most of these institutions stopped their engagement immediately. They stopped talking to companies. They said that we'll be very careful when we are engaging with companies from now on, because we don't want to be labeled as active investors. We are just holding the company because it is listed. If you don't want me to tell the company they have to disclose their carbon emissions, I will stop doing that because I don't want to incur that cost. After a few months, they reorganized their stewardship team. For the first time in 25 years, ExxonMobil get 0 environmental or social proposal in its annual meeting. And this company always gets a lot of proposals like that. So as you can see, regulatory environment really determines the type of oversight that institutional investors can provide. And if we insist on not fostering this productive environment, we might be actually losing some of the advancements or improvements that we already have, at least in disclosures. So the main takeaway that I would have from my talk would be that it is not only that institutional oversight is central to advancing sustainable finance, but it is something that we need to protect fiercely so that improvement can be sustained in the long term. So that's all I have for today. Thank you so much.
Great, thank you, Ipak. Thanks for sharing your insights on the role that portfolio holding and stewardship can play in this transition. So in the remaining time, about half an hour, we're going to have the Q&A. So I'm going to start with my question, because I'm going to take this liberty of priority. Okay. So I'm going to ask each of you guys the one question related to what I've presented just now. So we know I'm going to direct first question to Toby. So we know that the economy is moving very fast towards the transition to this no-carbon economy. Many countries, many firms has voluntarily adopted this net zero target or commitment. So for example, by summer this year, almost 40 countries or jurisdictions have committed. They're going to endorse this IFRS S2, climate risk disclosure. So basically, it's endorsement. Some countries just mandate the bigger corporation. For example, in the UK, the bigger companies with an employee of over 500, I think 1,000 employee, they have to disclose the climate risk starting in the fiscal year 2004. Okay, so we know the economy is moving very fast. At the same time, Toby, you have mentioned the financing is lagging. We are lagging in this transition, right? The financial institutions. So in your opinion, what would be the core or the major responsibility that finance or the banking institutions can do in this transition to this low carbon economy?
Thanks. I think one of the things Sebastian touched on is a real kernel with the public investor. So the Canadian Infrastructure Bank, the Canada Growth Fund, really interesting vehicles. And maybe Sebastian could correct me, but my understanding is that the fiscal impact, the mandate for the Canadian Growth Fund is $15 billion, and it has a mandate just to return the capital, $15 billion, no rate of return. And the fiscal impact of the federal government is really marginal, like it's in the like tens of millions of dollars per year, and so they're making money now, but even if they were just to return back the $15 billion without interest, the fiscal impact because of the low borrowing cost of the government is quite low. And when you have professional managers within PSP who know how to allocate capital as per mandate and can accept, concessional rates of return, that's a way to really mobilize a lot of money. And I fell prey to the Kool-Aid in the sort of like, I guess, the investor realm that you see many environmentalists repeating, which is that we cannot solve the climate change with public capital. We're going to need private capital. And you see here numbers like 70% of it will have to come from the private sector. That may or may not be true. That's not how China did it. That's not how the US got out of the Great Depression. In the US case, the public investor stepped up, and for 6 years, 1933 to 38, we should remember this history, for 6 years under FDR's leadership, that country invested 6% of their GDP as a public investor, building out power lines, electrifying America, all sorts of investments as part of the New Deal. And so we should not just accept at face value without some scrutiny that the public investor does not have a really significant early catalytic role. And I think in Canada, we're seeing some of those great things come together with the Growth Fund, with the Infrastructure Bank. I'd like to have a discussion with Sebastian about the ultimate return on capital for the pipelines and whether or not we're handing bigger stranded assets late in the game to our Indigenous friends who will be on the hook for a lot of liabilities if the transition goes faster than people think. But in terms of public policy, if we want to accelerate finance's role to be part of the solutions, public investor is going to be an important part. We are doing some important things there. And we have regulatory tweaks that we can do. We have a sustainable finance taxonomy that has taken up a lot of oxygen in the movement, and the Prime Minister committed to finalizing that taxonomy after the process started in 2018 to finalize it by the end of 2026. That will be important. I think it's perfunctory. We already have 6 income tax credits, clean economy income tax credits, which constitute a taxonomy if you weave them together. It's just not called the taxonomy, but there's $100 billion of tax subsidies tied to those 6 clean economy tax credits from the federal government. That is the most significant backbone outside of the public investments the government is making. That's the part to activate the crowd and the private capital, because it takes both. I don't think it's one or the other. I think there may be a more formidable role for the public investor. And then the mandate piece is absolutely key. We looked at the mandates. The UN hired us to look at the mandates of all the financial system regulators around the world. And we found that there's a really interesting diversity of approaches, whether you're in Bangladesh or in Europe or in the US or Canada or New Zealand. And in Canada, by and large, we, with the exception of the case, is a great exception, where it has a mandate to foster economic development in addition to earning returns for pensioners in Quebec. We have a lot of room to update the definitions within what is a bank, a Schedule I bank, what is a pension fund, CRA definition. And you have to meet that definition to qualify for immense privileges, economic privileges, to operate as a Schedule I bank, or to qualify for the tens of billions of dollars of federal annual subsidies that our pension funds get, which I would argue is mostly a good thing. But there is ways to tweak the CRA definition of a pension fund to include having to demonstrate credible alignment with net zero, which is the law of the land. That would be really impactful for the $2 trillion of capital controlled by our 35 largest pension funds with assets over $5 billion. And that could be an order in council, stroke of a pen. And most of the pension funds have the capacity to do it. And it would, they in private have told me, they would fight like hell in public against that. But in private, I've been told by 2 of the Maple 8 pension funds, the top executives, that it would lead them to allocate much more capital to climate solutions, and it probably would be for the better. Sometimes finance needs a little bit of a nudge, and that is one area where I think we could nudge a $2 trillion entity in a constructive way.
Thank you, Toby. My next question will directly to Sebastian. So in your talk, you mentioned the role that government can play in this transition. And I really like your insights talking about, this policy uncertainty and the role that you guys try to avoid competing with the private investment. You're taking more risky approach. So by definition, that means more likely you guys are going to fail than to succeed, right? So I'd like you to share us with a 1, 2, or 3 or zillions of example where the lessons you guys have learned or good practices you guys have developed in dealing with the stakeholders, or try to convince other people to jump on the board and to do this sustainability investment.
Sure, thanks. So crowding in capital is this on? That's the whole idea, right? And you're right. Canada Growth Fund, for example, they're not even losing money. They're making money. The returns are not what a pension holders would like. So they're able to do that in this particular situation on a contract for the government. Not competing with the private sector is interesting, and as I said, that sometimes the policy uncertainty is something that we deal with, and that's a very real thing. So I'll give you an example. We have a $10 billion program to protect and help companies, be the last resort for companies who are being impacted by tariffs. Very restrictive, very challenging terms on purpose. We don't want the private sector to get in. Now, you've probably heard in July, or maybe you did or didn't, it's just maybe nerds like us that follow this stuff, but Algoma Steel heard about the terms, engaged us, wanted a loan. They're in bad financial state, and found the terms to be terrible. They didn't want that kind of cash, and appealed to the minister, and now we have a loan to Algoma that reflects what they wanted. So basically changing the program in mid-flight when it starts to hurt. And so that's part of political reality. I will say, though, sometimes on the Indigenous side, we've found actually some leadership from the government, but more so by companies. And so you have big pipeline operators, big renewable energy providers like Brookfield, really proactively looking for Indigenous partners because they have regular proceedings from the regulator, and every single one of those touch points has a duty to consult Indigenous groups, and then a potential for a lawsuit, which will cripple your business if your permit is overturned and you've got to start from the beginning. And so there's some incentives that have been generated by the courts to do that. What we're doing is kind of supporting that. In the first deal that we did, we guaranteed $400 million of debt for 38 nations to buy part of a pipeline. But the Enbridge provided almost 45% of that financing themselves. And so they levered their own bonds and brought it to... so there's a huge alignment right now of interests, and I think that, on the environmental investments, again, there's a business case right now. It's not just concessional. It's not always a money-losing endeavor. It's also in their financial best interest to support these projects.
Great, thank you, Sebastian. So I'm going to move to the next topic about this matrix, because as a professor in accounting, finance, or as a practitioner in the finance, before we set our, do any decision, we're going to look at our goal, right? So what is the performance matrix or criteria we want to judge? So especially in the finance, we're educated that we are doing the trade-off between the risk and return. We need keep those the balance there, right? So the question to EPAC and Sebastian and Toby, is, in your opinion, what are some of the major metrics we like to use to evaluate our involvement as investor, as a portfolio managers in this investment decision? And if we cannot get it done, what are the action you can take to accomplish your goal?
Should I start? Okay.
Go ahead.
So in terms of metrics, I think our practitioners will give more detailed overview from an academic perspective. I think the most reasonable thing to use is industry-specific, standardized material frameworks, like the one that is developed by Sustainability Accounting Standard Board, SASB. So that when an investor is looking at a company, looks at the industry and understands what are the material sustainability risks that this company is facing, and focus on the disclosures on that. That is what I would suggest as an academic on the side of metrics. When it comes to making this system better, I would think first we need to understand again, yes, in finance we always think about this trade-off between returns and risk, but we have to underline this fact that sustainability is now part of that risk and return. For that reason, we should be really thinking about improving the long-term value, because if you're thinking about maximizing the long-term value, all of the sustainability aspects that are relevant for that business will come into the picture. In addition to that, I think we need to update our definition for performance benchmark. If a fund manager is being evaluated on his quarterly results, he's going to do things, he's going to do investments to maximize his quarterly results. So we need to lengthen our window, because as we all know, sustainability requires giving money now, investing now, and getting the returns in the future. In addition to that, we might be tying the performance or we might be tying the executive compensation for these fund managers as well, or the compensation for these managers as well, to ESG metrics, right, as we do for our CEOs in the public company. So this is something that we should be seriously thinking about. Maybe we should make the fiduciary duty clearer. Maybe we should underline the fact that sustainability is part of the material risk that you're supposed to be thinking about right now if you're BlackRock, right? We need to make that clearer so that people will not thinking about sustainability as an option, but as a requirement when they're making their investment decisions. And lastly, I will say the disclosures. We need to really focus on disclosures, because investments is all about getting the right data and using that right data to maximize whichever problem that you're trying to maximize. But the first step is to get the disclosures data. And based on the topic of the first panel, I will say we should focus on environmental disclosures and we should focus on carbon emission disclosures and get them as standardized as possible.
Great, thank you. So I also like to hear the insights from the practitioner about this metrics, what is material, immaterial,
So when you're public sector and you have a lot of money, you get a lot of great ideas coming your way. A lot of great projects that will make people rich, and they'll solve climate change. And that's simply not true, obviously. We probably see a high percentage of crazy versus credible projects. So the majority is the crazy stuff. But that's okay. So the first criteria for us is commercial viability. So we probably think about it similar to a private investor. So we're looking at rates of return. We're looking at some of the regulatory risks. We're looking at the management team's track record. We're looking at the debt service coverage ratio. All the metrics that typical lenders and investors would think about. So once that bar is understood, then we kind of move to the next level and think about things like, okay, so if you're the Canada Growth Fund, what is it that you're trying to do? So for example, they fund some critical mineral projects that are going to be used in next generation electric vehicles and things like that. And so how does that investment contribute to broad goals? And that's where it gets very fuzzy and challenging. I talked about economic growth. Again, really difficult to measure. Jobs, super challenging again because they can change. So the first one is always commercial viability. Is this a real thing? And with the Major Projects Office, we're in discussions with them on a weekly basis, and they get their fair share of crazy ideas as well. But then we have to go and fund them, and so it's a different story. But yeah, it's fascinating, and I think for us, it's about a conversation with the shareholder, which is the government, right? So as the objectives, they typically sound great from the Department of Finance when they're writing the budget. And then when you kind of unpack them, you realize, actually, this doesn't really fit. And so it's going back and confirming and validating and understanding kind of where they are.
Thank you. So I've got, there's two parts to here. There's the sustainability part, and then there's the macroeconomic benefit part. And one thing that we've observed, we've done work for Global Affairs, looking at what Canada's sort of clean economy exports are, and how we turbocharge that. And one thing I was really struck by is our entire federal government structure, unlike most of our other G7 trading nations, has no lens for domestic ownership. So we don't care if an oil company, a Canadian oil company makes $1, or if American oil company makes $1, as long as it happens in Canada, it's all the same for us. And that's a real problem. It's a 19th century mentality when we were capital poor, resource rich, and the economy was about sales and jobs. The economy now is about capital gains and dividends, and who owns prospers. And we are playing like Boy Scouts on the global stage, and our federal government apparatus has no lens. So when we say macroeconomic benefit, we might have a pipeline that has some benefits, then we look at who's benefiting from that, and it's companies that are 2/3 owned by foreign investors who are paying taxes and capital gains and dividends to those investors. Not here, we're not getting those benefits. So we inflate those benefits by a factor of 3 or 4 because they're not Canadian owned. Whereas in the power sector, mostly Canadian owned. It's a sovereignty play. So you build a power line that has $100 billion of economic benefits for Canada. Those benefits almost stay 100% in Canada. Whereas you have 2/3, 3/4 leaking in fossil fuels. That's not a lens that's there. And the reason it's not there is there's 600 lobbyists from the oil and gas sector meeting with Minister of Natural Resources and Prime Minister over the last 8 months, and only a handful from the publicly owned utilities don't have the same lobbying incentives. So that's against the public interest, and that sovereignty lens is really important. So macroeconomic benefit for Canadian-owned entities, ultimate shareholders located in Canada, really important. On the sustainability side, one thing, what we need to see, and Europe is doing this right now for all their major firms, is we need to see the percent of revenues that a firm is making that are aligned with a credible definition of sustainability. The percent of lending an institution is doing that are aligned, the percent of investments that are aligned with a credible definition of sustainability. And the reason this is so important, it's happening in Europe, this is where the whole world is going, there's 65 regional taxonomies, we'll get there, late to the party, but we'll get there here in Canada too. We do this and we track it. There's a lot of certifications out there. There's like 1,000 certifications, about 250 that are credible in our view. And I see the light go off in executive eyes. I was in a boardroom with one of the big 5 banks, and we were going through their loan book and how it had grown at twice the rate, the green loan book, than all other loan books. And you see the lights go off, and they're like, wow, when you put it in this box and you organize it all, and you see that the sustainable economy is growing twice as fast as the rest of the economy, it starts to focus minds on where you want to allocate capital. And so it is so important to credibly just measure and have this metric so people can see that dashboard, how fast the sustainable economy is growing compared to the rest of the economy, because then that will give feedback loops that can help it grow even faster, which is what we need to do.
Great. Thanks for sharing your insights. Thanks to all. And now I'm going to open the question to the floor. And so feel free to poke these guys.
Thanks very much. Two questions. So I work for a foundation based here in Montreal. The first question is, I really like, Toby, when you were sharing that in your mind, finance is now lagging the real economy. And curious if, in tying that maybe to the other points about data. are we lagging also the economy because we're just basing all investment decisions mostly on like risk returns that are based on historical risk and returns, and we're calculating means and standard deviations, and especially in public markets, like our entire framework is based on replicating the past. And so is there something to hack here? And that's maybe the first question on how do we base decisions on data that are maybe future looking, and how do we free ourselves from the past? And then, sitting at the foundation where we have, both similar to the government, we have concessional resources, we have grants, we have ways to do concessionary lending as well, and then we have investments because we want the endowment to grow over time and retain our granting power. So I'd love to dig deeper or have academia take on the role of digging into what concessionality means, actually. And for us, we're a third-party player, so we're trying to play alongside the private sector, alongside the public sector as well, and really being that third leg, and we're struggling also sometimes as well, and it'd be amazing to have more of an objective mindset on this, and curious more. Maybe for us the difference with the government is we do have limited resources versus infinite resources, or that could be possible. Curious on this also, if from academia or your professionals, sorry, two questions, if there's any special trainings to assess that notion of concessionality, so there's a CFA training for investors where we're great, very objective of optimizing risk and returns. How do we bring that in for other goals that can be longer term sustainable, that cannot be captured by past data? And does that exist in schools of public policy? Does that exist, within the CFA? Can McGill do something around that? Like, that'd be awesome.
Thanks for the question. So the key concept is about concessionality. Go ahead.
That one first, then. So maybe I'll take the second question because I think I understand it more because the other stuff is more others. But so I'm not aware of any training for concessionality, but I do agree that we need it. It really does kind of conflict with the traditional training of, as you say, CFAs and others, and I don't know exactly what it means. I think that a little bit, enough concessionality, but just the right amount. Really, that's what the government's trying to do. Limit the concessionality to projects that are, and opportunities that you want to advance for a public policy objective that you've defined, but just enough so that you can use your resources otherwise, right? And I think that's the trick. And even if you have a small amount or a big amount, our shareholder are certainly interested in us using every nickel as efficiently as we can. So.
Thank you, Toby. So for the sake of time, we have about 9 minutes left. So anybody want to ask a question, can raise your hand. I'm going to pass the phone to you, the microphone to you, and then keep your question brief.
Can I just tackle that first question? So the hack, I thought a lot about this. So currently, a lot of capital is allocated on a market cap weighted basis. So the bigger the company, NVIDIA will get the biggest share of your investments based on where it's valued today. That's inherently, market cap is meant to synthesize many things, but as we can see from oil companies, the market cap shoots up when the oil price goes up. It's not really tied to long-term fundamentals. A lot of it's tied to animal spirits. A more, I think, fit-for-purpose metric, and Rob Arnault, who's investment sort of maestro of new indexes, we've talked about this as well, is you can design an index or strategy where you modify your weights from market cap based on the compound annual growth rate of the revenue of that company, and that's more of a forward momentum. I would argue that you get more refined results and better results, which we've recently completed an analysis with one of the top 3 pension funds in the country who are looking at putting a sizable investment strategy behind this, is they found that the companies with the highest sustainable revenue growth rates over the last 5 years have substantially outperformed the market in uncorrelated ways. And the reason that's better, I think, than just revenue growth, the sustainable revenue growth, is revenue growth can be a lot of things that are noise, that aren't tied to an intuitive logic or coherent macro secular trend, whereas we know the sustainable economy is on track, it's doubling every 4 years, and that's been going on for the last 8 years. And it's going on for a lot of reasons, from policy, from technology, and from necessity, technology being the main driver now. And technology always wins. And so if you can tap into a technological trend, it doesn't have to be just sustainability, but that's the one I know about. And it's a big one, it's a tenth of the economy now. then you could, if you were shifting your allocations so that it wasn't just market cap, and then at the extreme scenario, it was just purely based on sustainable revenue growth, then you'd be positioned for the future in a much better way.
Thank you. So we have the next question here.
Hi. My question is for Toby on the shift from shareholder primacy to stakeholder primacy. Yes, we can all understand that there are some activity sectors where I think it is warranted, but how low in the business world do you want to go? I'm going to give a silly example. Do you want to go as low as a 3-employee convenience store? No.
Okay, go ahead. And then my second question is there, and then I can have another one. Another question?
Yeah. So
Okay,
I think in general, regulation should leave small businesses the hell alone, in general. In general, like when we look even what CRA is doing when they go after people not paying their taxes, they're leaving the sort of the $1 billion tax avoiders, because it's too complicated, Brookfield being one of them. And they're going after these mom and pop shows or somebody who didn't pay back their. So in general, I think what Europe has got right, it's some environmentalists don't like it, but their regulations to require disclosure around sustainable revenues and investments was meant to apply to a much broader array of companies, including relatively small businesses. And as part of the sort of populist sort of right shift in Europe, that was pared back, and now it just applies to sort of the bigger companies, 500 employees and over. And when I talked about the pension fund disclosure, there are tens of thousands of pension funds in this country. And I think it would be onerous and expensive and detrimental on a lot of levels if we required all of them to disclose how their investments align with the net zero world. But there's $4 trillion of investment capital in our pension system. $2 trillion is with 35 funds. Those funds, they have $5 billion, they have the capacity. So I think that's a really good point you make. I think most of this regulation where you're establishing table stakes should be focused on the sort of entities that make up half of the pie, but only 1% of the actors, and have the capacity to follow through and arguably the responsibility to come to a higher level. The carrots should be available to everybody. I would argue more carrots available to the smallers. And I also think just on that level, because I think the SME, the small medium enterprise, is such a critical part of economic democracy and of having more resilience and also equity. There could be an industrial strategy for Canada to help to finance not just companies that are doing the transition, but are disrupting domestic oligopolies, which are levying tens of billions of dollars of taxes on Canadian consumers, because we have, whether it's our grocery or our banking systems or our telecommunication systems, we have a country that is basically significant portion of consumer oligopolies that have not been able to be disrupted, and I think there is a role just to take after consumers, and it would be good for our growth, and it would be a reduction of tax, an oligopoly tax on us as well. But I am really glad you raised that point, because small and medium businesses do not need to be regulated anymore; they need less.
Thank you. So we have one more question there in the back.
One question. I have two actually. First of all, this question is directed to Toby. You mentioned that since July of 2025, that there's a deficit in resources. Now, how can you solve that problem when you need these resources, like to build the windmills and the solar panels, in order to transition to renewables?
Sure. Great question. There's two things to note here. So in the energy transition, we're basically, it's at a big picture level, it's about shifting our impact on the atmosphere with emissions to the lithosphere for minerals. There's a lot of we need a lot of critical minerals for all the batteries and the wind turbines and solar. From an emissions perspective, though, if we can get those minerals out of the ground and recycle many of them as well in ways in local partnerships, big opportunities for Indigenous people in Canada. But if we do that, then that's good socially. Environmentally, if we look at the sort of life cycle environmental impacts, on the sort of the call on nature that making a solar panel makes compared to the benefit it creates from displacing fossil fuel energy, it's about 90 times more. So for every 1 unit of impact of making a solar panel, you get 90 times more benefit from displacing fossil fuels. So there is an impact for making solar panels, there is an impact for making wind turbines, there's cement, there's steel. But when you look at the life cycle costs on nature, it's about 1/90th of what the fossil fuel counterpart is, depending on how you do it. So it is not nothing, but it is quite minute. And the key is to do it faster and to do it in more socially acceptable ways.
Okay. My second question is for Sebastian. I'm not sure if this is under your jurisdiction or authority, but what is the probability that the pipeline that Alberta wants will be approved? 50-50 is not an answer.
Good question. So I don't know. I don't know anything about that project because there's no proponent and there's no plan, right? And so, we talked about Trans Mountain in the media today or yesterday. I think you saw. We can optimize the production and the output by 30% just by using that infrastructure more efficiently. So I think, to me, once that's fully optimized, that's the right time to look at new pipelines, although don't quote me on that, and I'll never admit to saying that in public.
Thank you. Thanks to the audience, the wonderful audience we have here. Thank you. And especially to our distinguished panelists, Toby, Sebastian, and Ipak. Thanks for your insights.
We now invite you to take a 15-minute break and be back at 11:15 for the second panel.